America 2020, the real state of the union and the economy. Hi, I'm Dave Okenquist, and that's the theme of our upcoming Irrational Economic Summit taking place next month in Washington, D.C. Joining me is one of our presenters, Dr. Lacy Hunt, the Vice Executive VP of Hoisington Investment Management. Lacy, great to talk to you.
Great to talk with you as well.
Always good to connect with you. Dr. Hunt is one of our most requested, most popular speakers. Everybody always wants to hear his expertise. So even for me, it's great to join. I always learn something every time we interact.
Well, thanks. I'm going to try to have some interesting things to say.
Okay, no pressure. Now, Dr. Hunt, we talked last year about how things were going in the economy. We sort of laid it out. We spoke in this forum here. We also spoke at last year's Irrational Economic Summit. Now, things have changed a bit over the last year. We now have a trade war between the United States and China, more coming to a head. We have increasing recession fears in the U.S. and globally, and central banks have been slashing interest rates. At least to my count, about 20 central banks around the world have cut interest rates. So how do you see things as they stand today?
Well, we have a synchronized global downturn. All of the manufacturing sectors in all of the major economies of the world are in recession right now. That's your high value added. The German economy is in recession. The Japanese economy appears to be headed into a recession. Growth in the United States is decelerating. Chinese growth is better than here and in Europe and Japan, but it is a 28-year low. So we have very poor subnormal economic conditions. It's pulling inflation rates down, and it's producing this trend toward lower interest rates. I think that the two main causative factors that have produced this situation is that there is too much debt. We're continuing to experience a very rapid debt acceleration. And when government activities are financed by debt, economies only get a very brief blip. And then the debt becomes a burden, and economies experience diminishing returns, and business conditions get worse, not better. Another problem that's interfacing with the excessive level of debt is that the Federal Reserve engineered a major monetary deceleration, beginning in 2016, in which they cut the rate of growth in M2 in half. They slowed the rate of growth in bank lending very dramatically, and they also generated conditions that led to an inversion of the yield curve. So we have the negative effects of excessive indebtedness superimposed on it by a restrictive Federal Reserve policy that has reduced world dollar liquidity and resulted in a slowdown in monetary growth in Europe, Japan, and in China at a time when velocity is falling in the U.S. and all of the other major areas of the world.
Now, you mentioned the inverted yield curve. That came out a couple weeks ago, and everyone was screaming with their hair on fire that a recession is coming, because typically that's the case. Do you see that same pattern emerging this time around?
The yield curve per se is not causative. It's a reflection of monetary restraint. And once the yield curve so initially, it's a symptom of the fact that the central bank has tightened things considerably. But as the yield curve gets flatter and flatter and then starts to invert, then that reinforces the monetary restraint. And it has an adverse effect on all of those that are borrowing short and lending long. The lead times are never very precise. But what we have in the economy today is a car that's driving around, and it has a tire that has a slow leak, and there's no replacement for this tire. And because the car is still in use, the leak is getting worse.
Right.
And this is a slow process, but the risks to the U.S. economy at the present are clearly to the downside.
Now, the Fed, it almost sounded like from earlier in your statements that the Fed almost sort of caused this leak. And then as the yield curve inverts, does that also give them almost no choice but to lower rates on the short end? Does it sort of create like a feedback?
Well, they played a major role, but remember, you had a $1.5 trillion tax cut over 10 years, financed by debt. Then you had another $1.5 trillion of new debt as a result of the bipartisan increase in spending in January of 2018. And then there was a bipartisan increase in spending in June of this year for another $1 trillion over the next 10 years. So we're heaping debt upon debt, which is a negative force. But the Federal Reserve played a very heavy role. And when the Fed has historically engineered a monetary deceleration of the type that we have witnessed, there's about an 80% risk of recession. And the inversion of the yield curve, the longer that it persists, increases the risk of recession.
Now, let's talk about treasury rates a little bit. One of your big trades has been calling for lower treasury rates. I believe you've had that trade on for years, and you've talked about it at our conferences. So talk a little bit about that and where you see treasury yields going over the next medium to long term.
Well, the long treasury yield is determined by one of the pillars of macroeconomics, the Fisher equation, which says that the treasury bond yield, the rate that we all follow, is equal to the real rate plus expected inflation. And both of those components, the real rate's coming down and inflationary expectations are coming down. Okay. The real rate is being pulled lower by the faltering growth in economic activity. One can think of the GDP growth rate as the rate of return on the total economy for your mid-range risk. And so as the growth rate comes down, the return for the overall economy comes down. That pulls down the real rate.
Okay.
As economic growth slows, that also pulls down the inflation rate. And in Europe and Japan, where the real growth rates are much worse than they are in the United States, and inflation is also slightly lower, we have a situation where both the real 10-year long-term rates, treasury rates, and the nominal rates are both negative, and the economy is not responding to them. And there's a very good reason for that, because when you push the rates down toward the zero bound, even before they get to the zero bound, there are negative feedback loops. And these negative feedback loops actually are a more serious drag on economic activity than the reduction in rate. In other words, the drop in rates do not help. They actually hurt.
Gotcha.
They cause the national saving rate to go towards zero or even negative, and without adequate saving, you cannot have real investment. You also basically undermine the viability and sustainability of the banks and the financial institutions. They cannot operate at a profitable and healthy level in a negative interest rate environment. And another negative feedback loop is that the unfunded, the present value of unfunded liabilities explodes. If you do your present value calculation with negative interest rates, your future liabilities go to infinity. And so the net result is that the rates are coming down, but the economies are not getting any better. And part of the reason is that at this stage of the game, the rate reductions are not a panacea. They're more of a problem.
Interesting. You breaking down the economy like this and explaining this, Dr. Hunt, is why you are one of our most requested presenters, because you can explain this stuff so well.
Well, thank you very much, and I look forward to elaborating on each of these points.
Yeah, absolutely. Before I let you go, Dr. Hunt, the year 2020 is looming large, especially politically. We're going to have a presidential election. And it's interesting because we now have a president who is all openly berating the Fed chair, calling for certain policy adjustments, specifically to lower rates. To what degree does the election, politics, and how does that relate to Fed policy? How does this all sort of come together with these existing structural issues?
Well, I will tell you something. I try to avoid the politics.
Yeah.
I also try to avoid the noise of day-to-day markets and keep focused on the fundamentals. And the fundamentals are that we have a major debt overhang, which is undermining growth and causing low inflation and low interest rates all around the world. Mm-hmm. And the other fundamental that I'm really focused on is far more important to me than the outcome of the election, is that because of the debt overhang, the velocity of money is going to continue declining. It's extremely low, but it's going to move lower. And so what we're going to find out, just as the Europeans and the Japanese and the Chinese are finding out, that when the Fed reverses policy, the decline in velocity is going to basically make their easing operations impotent. Mm-hmm. In other words, when they tighten, they can produce a downturn in economic activity, but monetary policy does not work when they're trying to stimulate the economy. Or we've basically exhausted our monetary policy options. And to me, that is far more important. Now, with regard to the trade dispute, as of right now, the tariffs that have been actually levied are worth about $10 per person in the United States. This is not a significant sum. Mm-hmm. Moreover, the Chinese yuan has fallen in value. So the tariffs were raised on a very small number of items, but yet the total market basket of Chinese goods has gone down substantially because the dollar has risen against the yuan. Mm-hmm. And to my way of thinking, the trade dispute gets a lot of attention in the media and in the press, but it's really a bit player. It's not a major player in determining what's happening for the U.S. economy.
Great to know. I know this is just the tip of the iceberg of all the things you're going to cover at the Irrational Economic Summit. So I want to thank you for joining me. Thanks for connecting and having this conversation. Very much looking forward to seeing you again. Again, the Irrational Economic Summit is in Washington, D.C. on October 10th through 12th at the Gaylord National. So reserve your spot now. For Dr. Lacy Hunt, I'm Dave Okenquist, and have a great trading day.